Thanks, Sarah. Morning, folks. So this is like the end of 2 full weeks, really, for the Chamber team. Like a lot of you working remotely from home. That experience took us a good bit of getting used to, but I think we're all working actually pretty well. I think the challenge this week is just making sure people are being looked after, because everybody, I think, is now beginning to creak a little bit under the strain of either being in your house on your own with no other real company, or actually working probably harder than you've worked when it was your normal, whatever normal looks like for you. And the Chamber's been doing a lot of things. So apologies if you've heard this already, but we have got a COVID-19 hub, like a lot of businesses do. A lot of support organisations have got similar hubs, but on there you've got information about business support, about health advice, about links to government, Department of International Trade. There's a whole bunch of online support that's available. The key thing for us this week has really been trying to make sure businesses have got access to all of the support mechanisms they need to be applying for. So we're already hearing of people who have applied to Dundee City Council for their grant relief, got acceptance of their application form, and payments should start winging their way. Now, this is not gospel, but I'm hearing that local authorities are possibly going to make those payments as of next week. And I guess the good news for that is because it falls into next year's tax year. So, from a tax point of view, it's probably quite a handy thing. So if you have applied, and the number of applications across the 3 local authorities now region is well into the 2000s. So they're dealing with a lot of applications, yet we don't know the fail rate. So we're really keen to hear of any business that's experiencing any issues with applying for any of those schemes, applying for the business loans, or anything else that you're experiencing, because as you might imagine, we're doing a lot of talking to government. So we've also been sharing a lot of good news and trying to kind of give a spotlight to any local business that's doing any delivery schemes. So we've got a page on our website with a whole host of businesses that you could get a delivery right to your doorstep from, all of whom are obviously kind of making sure that social distancing and hygiene are all at the top of all their agenda. So, and something that's just literally hot off the presses that has launched today is a new programme called Partners for Business. So our Platinum partners and our enterprise partners, we got them together last week and said to them, can you help businesses? And they said, yeah, of course, what can we do? Well, we said, well, a bunch of things. You could speak on some of our webinars, hence today's webinar. You could also give us some articles so that we can share your expertise online. But how about a mentoring programme for businesses? So every one of our Platinums is really up for supporting and doing what they can. So if you're a business, you might be in the thick of it and actually you've got so much business you don't know what to do with it, but that's an issue in itself. Or you might be having real difficulties and you're trying to work out how to change and come out of this and create a recovery plan. Get in touch with us. I'll put up the link on the chat in a little while, just so that you've got that. I'll maybe not do it until our speakers are finished so that you're not too distracted. But I guess that's a bit of an update from the Chamber. We're here to listen to any business at this time that's looking for support. So please give us a shout, let us know what's going on for you. And if you've got a good news story, please send us it so that we can share that on. We've got 3 speakers today. So we've got Debbie and Chris from Thorntons, and we've got Jenn from Johnston Carmichael. And I'm going to hand over to Debbie in a minute, and then they'll kind of have some slides and hand over to each other, and then we'll have time for questions. So Debbie, could you unmute yourself and I'll get out of the way? Thank you.
Hi, good morning, everyone. I'll get right into it. Time is short. Having been an employment lawyer for nearly 20 years, I'm used to regular changes to employment law, but never at the rate that we're seeing and have seen over the last few weeks. It feels that new guidance has been issued sometimes on an hourly basis. What I want to talk about is the job retention scheme. As a result of the economic impact of COVID-19, the government's introduced the coronavirus job retention scheme. Now, the scheme is intended to avoid redundancies by alleviating pressure on employers to continue paying wages in full during this crisis period. The scheme will apply in respect of employees who have been furloughed, a word we're all becoming familiar with now. So it's people who have been put on a period of leave during which they are not required to work. Now, the scheme doesn't change the employment relationship between the employee and the employer. It allows the employer to agree on a temporary leave of absence, and then allows the employer to recover a proportion of pay from HMRC in respect of employees furloughed. Now, an employer can claim from the government the low of either 80% of wage costs or £2,500 per calendar month, plus national insurance contributions and employers' minimum auto-enrolment pension contributions per employee. All UK employers who have a PAYE payroll and a UK bank account as at the 28th of February year, other than those receiving ongoing public sector funding towards their staff costs, are eligible. Now, in terms of those receiving public sector funding, they're expected, if that's for staff costs, they're expected to continue to use that in the normal way. No need for them to furlough under the scheme. So what employees are covered? Well, it covers all individuals on your payroll as at the 28th of February. It doesn't matter what type of contract they're on, full-time, part-time, agency, flexible zero-hour contracts are all covered. Self-employed or not, and there's a separate scheme for them. The scheme is aimed at those employees who an employer would otherwise be laying off, being made redundant, a downturn in work. So further in the COVID-19 guidance, it makes clear that those who are furloughed shouldn't be doing any work for their employer while they're furloughed. So it won't apply where you're just if you're cutting people's hours or introducing a pay cut, as they would be continuing to carry out work for you. Employees who you already made who were made redundant since the 29th of February, prior to perhaps the introduction of the announcement of this scheme, are eligible, but you will require to re-engage them and then furlough them. How do you calculate the wages of employees who are on variable hours? Well, if the employee has been employed or engaged by you for a full 12 months prior to the claim, you can either use the same month's earnings from the previous year or an average monthly earnings from the 2019-20 tax year. If they've been employed for less than a year, then you can use an average of the monthly earnings since they started work. I'm just going to move on to look at some. We're dealing with an awful lot of questions from employers on this, so I'll touch upon some of the things that we've been asked, and then there'll be an opportunity at the end for you to ask any other questions that you want to ask of this. Can you automatically put people on furlough? No. The guidance for employers makes clear that this is a change to an employee's status, i.e. they're not going to be at work. So it is subject to existing employment law. So what you means in practice is that you're trying to get the agreement of the employees to place them on furlough. And obviously the incentive to the employee is that the potential alternative to that is a redundancy situation. Alternatively, you may wish to ask for volunteers. It's another approach that we're seeing from employers. Or you may want to go through some form of selection. If you're going to be selecting people, if you're just reducing the number of employees, then you need to make sure that selection's fair, because discrimination law still applies. What's the position of those who are on sick leave? Well, the guidance has said that the scheme is to protect employees who are otherwise be laid off. If an employee is on long-term sickness, then they're qualifying for sick pay. They could only be furloughed if they were to return from sick leave and then be furloughed in those circumstances if you have that downturn in work or a potential redundancy situation. If they're self-isolating, then they're qualifying for SSP. There is a particular exception for those who are shielding, and that's the people that are classed as extremely vulnerable, those that will have received a letter from the NHS. So in those circumstances, you can furlough those who are shielding. And each job is separate. If people have more than one job, then they can be furloughed by each employer. It's a separate, and the cap applies to each employer separately. Another interesting question that we're being asked is, can you rotate between employees? So you might require some staff presence. You might think the fairest way of dealing with this is to rotate the furloughing. It's not expressly dealt with in the guidance. Some might say it may not be in keeping with the objective of socially distancing people and avoiding the spread of infection. But I think what it does say is that furlough should be for a minimum period of 3 weeks. And I think that does open the door to potentially rotating those on furlough, as long as you are aware that there is that minimum 3-week period. I think I've also covered off that it's important to remember that they can't do work for you. However, they have clarified in further guidance what work means. They can't undertake work or training which provides services to or generates revenue from the employer. So you can ask them, so they can carry out some training if there's some mandatory training or online training courses that they could be doing. They could be doing that. You have to be careful in those circumstances that if they do that, they have to be paid at least the national minimum wage for the time that they spent on the training, if the 80% of their wage is below that level. They can also carry out volunteering, and in fact you might actively encourage that while they're furloughed. A trickier question that we're finding is a couple of things around holidays. So do employees accrue holiday while they're furloughed? We think the answer to that is yes, although there's no specific guidance. It's a type of leave. They're employees, so I would have thought they are accruing their holidays. But can you ask them to take holidays while they are on furlough? It's not 100% clear, and I do apologise, a lot of this isn't 100% clear because the guidance is just coming out on a daily basis. The government guidance has been silent on whether you can oblige them to take leave. Ordinarily, you wouldn't expect someone, for example, if someone's sick, you wouldn't expect them to be able to be on 2 types of leave at the same time. So you can't be on sick leave and on holiday leave at the same time. However, there is a slight difference here is in terms of maternity leave. They are saying that you can claim back contractual maternity leave, which would suggest you could be on maternity leave and furloughed. So on that basis, there is a potential, it suggests that you may be able to ask people to take holidays while furloughed. If you're happy, I suppose, for people to cancel their holiday leave that's already booked, then obviously you can do this. On returning to the business, you would want to agree with them how they can, when they'll take those holidays. If you want them to take their holidays during this leave, there is a risk. They do come out and say that you can't recover that cost during the job retention scheme. In terms also of what the employees would be entitled to be paid, then it depends on what the contract says. Under the Working Time Directive, for the first 4 weeks of somebody's leave, you have to include all allowances, bonuses and regular overtime. Anything over and above that, in terms of holidays, they would only get their basic pay unless the contract provides otherwise. But remember, if you're claiming reimbursement, you're only going to get 80% of basic pay because the scheme excludes commission and bonuses, etc. It's also worth highlighting that the government has introduced the Working Time Coronavirus Amendment Regulations, which allow employees to carry up to 4 weeks annual leave over into the next 2 holiday years. I think the aim of that is to avoid employees taking a large number of accrued annual leave days when they return to work. And you might want to consider that option if you think there's going to be an influx of annual leave requests when your staff are all back in the office. I think those regs are specifically geared more to industries where, because of the work they're doing, the key worker status, you don't want them to take their holidays. And again, just to touch on maternity leave, guidance does say that employers can claim for enhanced maternity pay through the furlough scheme, and that suggests that employers can furlough employees on maternity leave. You will be able to reclaim the SMP in the normal way, subject to the normal rules, and then you claim for the enhanced pay on top through the furlough scheme. That's a bit of a quick run through of some of the issues that we're seeing, but as I've said, I'm happy to take questions at the end. I'll pass over to Chris, who's going to cover off some of the loans and other support available to employers.
Hi there, sorry, it's Chris Allan here from Thorntons. I take it everybody can hear me? Thumbs up, yeah, okay, no bother. I will just go back to sharing the slides. This is a very quick, okay, so what I am going to speak about is mainly, I'll put a slide up there showing what the main other assistance that's been given for business. One of the things I've not listed is the help for self-employed people, because I know that Jen is going to be touching on that. What I'm going to mainly concentrate on is the top line, which is the Business Interruption Loan Scheme that's been put into place, and also at the bottom of the page, certain issues coming from the proposed relaxation of the insolvency law. Just one small point to mention at the bottom though there, the protection for tenants of commercial premises. If you are a tenant under a commercial lease, there was a bill passed in the Scottish Parliament yesterday. Previously, the period of notice you'd have to be given for a lease to be non-payment of rent was 14 days. That's been increased to 14 weeks, presumably for the period of this disruption. So the Coronavirus Business Interruption Loan Scheme is a temporary initiative. Looks like it's going to run for 6 months anyway. That can provide facilities of up to £5 million for SMEs across the UK through a series of accredited lenders. Now, it's intended to allow access to finance for SMEs where specifically the coronavirus pandemic has prevented this, and it's intended to assist in particular in procuring overdraft finance, term loans, invoice discounting or asset finance. Now, the website talks about there being 40 accredited lenders. I went and counted them before I did the slides, and there was 37. And then I went on last night to check and counted that right, and there was only 36. So I think it might be changing from time to time as to who an accredited lender is. But you have to make your applications through the accredited lenders. So if you go to the British Business Bank's website, they have got a list of them and contact details there. Now, what the scheme does is the UK government provides the lender with a guarantee of 80% of the loan, and have underlined the fact that it's the lender that's provided with that guarantee. The borrower still expected to be responsible for the whole of the loan. Now, it's left to each of the individual lenders to assess eligibility and the terms of the loan that they would offer, and I'll come back to that. And up to £250,000, the lending can be completely unsecured, but above that, there either needs to be security or a reason for the absence of security or establishing the absence of security. And as an added bonus, the government is undertaking to pay interest charges and any facility fees under the agreement for the first 12 months. Now, the scheme went live on a week past Monday 23rd March. And at the moment, it's going to replace the Enterprise Finance Guarantee Scheme, which did operate. In terms of the support that's available, the borrowing, the different lenders will have different types of finance they'll provide. But for the overdraft and invoice finance, that can be termed, the repayment period can be up to 3 years. And for term loans and asset finance, it can be up to 6 years. Now, the scheme is been introduced primarily to assist SMEs. There is a bit of an issue here. As you see from the first line, eligibility is turnover of not more than 45 million. There is a separate corporate finance scheme that's aimed at companies that have got a credit rating, and there seems to be a big gap in the middle, so that's causing a little bit of angst. Now, your business would have to be UK based, turnover of not more than 45 million per year. It would have to generate more than 50% of its income from trading activity, so any kind of passive investment income or income from let property wouldn't be counted in that. It's to support trading in the UK. Now, if you're an exporter, there are a raft of supports available for exporters that are still existing, still operating, and the maximum amount that can be borrowed is up to 5 million. Now, it's supposed to cover borrowing proposals where not for the coronavirus pandemic, they would have been considered viable by the lender, and the lender believes that providing this finance now will allow you to trade out of short to medium term difficulties. And there's not really any kind of sector requirements here. All sectors can apply for the full amount of the facility. There's also no guarantee fee for businesses to pay under the Enterprise Finance Guarantee Scheme. The borrower paid a fee, but here the lenders will pay a fee to be an accredited lender and access the scheme. In terms of security, it's at the discretion of the lender. So they are allowed to lend below £250,000 without security, and above that they have to justify if there's not going to be security. but it's been made clear that the primary residential property of the directors or the business owners cannot be taken as security under the scheme. Now that's a little bit of a false position, though. If they're granting a personal guarantee, all their personal assets are going to be at risk. It's just that there specifically won't be security over their primary residential property. Been in existence for less than 2 weeks, and there have been a number of issues that have arisen. So last week, during the first week of the scheme, a number of our clients applied and were told that the directors would have to give personal guarantees, so they withdrew their applications. Now, this might be because banks were thinking that this is similar to the Enterprise Finance Guarantee Scheme, where under that scheme they would look for a personal guarantee or confirmation that there was no effective guarantee available, either because the director didn't have any appreciable assets or all the assets were already subject to guarantee obligations. Now, this was a bit controversial, so and the government were making their displeasure known. So the big four lenders have all committed to not seeking personal guarantees for loans of less than £250,000, and there's clearly pressure on other lenders to follow. Above that, it's at their discretion. One of our clients discussed their borrowing requirements with their bank, and their bank suggested a loan under this scheme. So this surprised us a bit because they already had an existing overdraft that was available. Now, that went up further up the chain in the bank and came back to the view was that they couldn't be eligible for a CBIL loan unless they'd exhausted their current borrowing facilities. Now, most overdraft facilities will have conditions in them which would allow the facility to be removed in certain circumstances. That could include there's been a material adverse change, or the borrower ceases trading, or the bank reasonably believes that they're going to breach any of the conditions of the loan. I did wonder whether the banks might start agreeing to remove the existing overdraft facilities and instead offering their clients CBIL loans, which would come with the benefit of the first year interest free. And then effectively these existing loans would squeeze out any new loans. Not seeing it so far, but the other thing to remember is that the banks could pull your overdraft facilities anyway for any of these reasons. There's clearly a lot of soft pressure from the government for the banks not to do this kind of thing, but at the moment there's no rules against it. The intention is clearly to allow loans on normal commercial terms to be issued as if the pandemic disruption was not occurring. But we're obviously not in that kind of situation, and it was fairly clear that a few of the lenders in that list are not. You'd kind of call them second-tier lenders in some ways. They kind of tend to lend in more riskier propositions, and they were clearly seeing some of these loans that were being brought to them as higher risk distressed loans. And there's been media coverage of interest rates of up to 30% having been reported as being sought here. Now, I'll be honest with you, this is all going to change, I think. So yesterday, the BBC reported that a fifth of smaller companies were likely to run out of cash within a month, and the loan scheme wasn't working quickly enough, although for obvious reasons, because everybody's working from home and the banks are shut. And there was also quite a lot of reports of companies just being told they weren't eligible, and a common reason was if they'd made a loss in the last financial year. And that's clearly going to work against like early stage companies, for example. So by last night, Sky News was reporting that this scheme was going to be overhauled before the weekend, and that seems to be getting reported in the BBC this morning as well as being a fait accompli. So it's likely we're going to see some changes to this. I don't know what, because at the end of the day, it's being left to the individual banks to decide at their discretion what they're lending and what the terms are. So unless the government get more prescriptive with the banks as to how this is going to work, it's still going to be left like that. I think one thing to note, though, there has been a very inconsistent approach between the various lenders. So if you do apply for one of these loans and you're told that you're not eligible, unless it's very clear you're not eligible, I wouldn't take that as necessarily gospel, and you could approach another lender and be told something else. Lastly, there's also been some discussion surrounding potential relaxations of insolvency law. Now, on this part, I'm really here speaking about businesses that are trading through a limited liability vehicle like company or limited liability partnership. So generally these businesses and the people that operate them, you're benefiting from limited liability protection. Let's be honest, a certain level of business failure is always going to be inevitable, and as a general rule, you shouldn't be personally exposed to your business's insolvency where you've not engaged in any improper conduct. Now, one of the suggestions that's been put forward, and it seems to be coming through soon, is that there will be a relaxation to what they call the wrongful trading rules, and that will take effect backdated to 1st of March. Now, what wrongful trading is if you can imagine when a business starts to suffer, it doesn't tend to fall off a cliff all the time. There's a kind of a gradual progression. At some point during the move towards a formal insolvency, it should have been obvious to the directors that they weren't going to be able to trade out of their insolvent position. So if the directors were to continue to trade beyond that position and make the losses worse and a greater exposure to creditors, they could be personally liable for that increased amount of loss. Now, it's very much a theoretical risk in many cases because, particularly when you're dealing with smaller companies, you need the company to go into liquidation, and at that point you effectively require a creditor to fund the court action because the liquidator's got to bring a court action against the directors concerned. So you're really looking at really egregious conduct to justify an action of that type. But they are talking about effectively removing that rule for the duration of the pandemic because it's difficult for people to see forward as to what's going to happen. In terms of other issues for personal liability for yourself, always remember personal liability under contracts and guarantees. Now, most people recall bank guarantees they've granted, well, not always, but they usually do. But they don't always remember or sometimes realise that they might have signed a contract which puts them up for liability in a personal capacity. It's very common in hire purchase and lease purchase contracts, but there was a time when general suppliers tried to get directors to countersign at the bottom of things in a personal capacity as well. Now, personal liability for non-payment of tax, again, tax that doesn't normally translate to personal liability. There's obviously going to be a lot of arrangements being made, either formal arrangements with the HMRC or just people paying other things other than tax. The one thing to point out is please make sure you don't, if you are going to not pay any tax, make sure that it's not PAYE and NI, because it is possible for personal liability notices to be issued for non-payment of those taxes. If you're looking to put personal funds into your company during this period in any way, unless the bank are asking you to put it in for share capital, it doesn't make much sense to put it in for share capital. It makes more sense to put it in for loans. If you are going to put loans into your company, it would be worth looking at whether it's possible to get security for that. That will put you in a better position. Now, it won't always be possible because the bank might have the security and might not want you to do that without putting in place ranking arrangements that would take ages to deal with. But if you can, get security. Other thing to remember, if they are going to relax wrongful trading, there is another side to this, and that's the people who are trading with the people who are not concerned about the greater losses they're running up. So everybody's going to be in the same position. All I would say is be a bit more careful with regards to credit that you might extend during this period because these protections have gone. And the other thing that often gets brought up is paying creditors in a different order, or you'll find people say you can't pay creditors unless you're paying them all proportionately. Unless you're paying yourself or a connected party, or specifically working a situation to pay somebody else at the expense of the other creditors, I wouldn't be too concerned about this rule. It's creditors because you need a supplier to supply with something, or you need a service. So otherwise I wouldn't be too concerned. Now, I'm going to hand over here to Jenn Stewart from Johnston Carmichael. I'm happy to take questions at the end, and I've also got my colleague Pamela Muir, one of our insolvency partners, who's on the seminar as well, who can pitch in with any answers to questions at the end as well.
Okay, thanks, Chris. I'll just share my screen now too. Okay. Okay, so can everybody hear me and see me okay? So good afternoon all. For those of you that don't know me, I am Jenn Stewart. I head up our team at Johnston Carmichael in Dundee, and I am also a licensed insolvency practitioner. So, oh, sorry. Can you all hear me okay? Yeah? Yeah, sorry.
Yep, it's fine.
Oh, sorry, thank you. So basically, Chris and Debbie have already touched upon the furlough scheme and the business loan scheme. So what I wanted to just touch briefly on is the self-employed income support scheme and some of the other government measures. So the self-employed income support scheme is a taxable grant worth 80% of your average trading profits over the last 3 years, if applicable. And to work out an average monthly grant, which will be capped at that £2,500 per month. So the access for this is across the UK for at least 3 months and is extended if necessary. So are there any restrictions? And one of the following must hold true. Your trading profits in 2018-19 must be less than 50k, and these profits make up more than half of your total taxable income. Your average trading profits in 2016-17, 17-18 and 18-19 must amount to less than 50,000, and these profits make up more than half of your average taxable income over the same period. You must be trading at the point of application, except for coronavirus, and intend to continue to trade in the tax year 2020 to 21. And another key element here is that you must have filed your 2018-19 tax return by the 23rd of April to be able to qualify for the scheme. The deadline for this has been extended to the 23rd of April 2020 for those who have not actually submitted or filed that return. So it is anticipated that this scheme, the funds will be available from early June, and HMRC will contact you directly and ask for an online form to be completed. And like the other measures, it is to be backdated for the 3 months up to the end of May 2020, and the funds should be paid directly into bank accounts. The other important measures that we have in place are the next quarterly VAT payment has been deferred. So payments deferred from now until the end of June, and companies will have until the end of the financial year to pay any deferred VAT. The really key point to note here is the payments are not being waived. They will fall due at some point. So payments does still require to be made. The same with the income tax payment on account due on the 31st of July. All taxpayers with a second self-assessment payment on account due on 31st of July will be able to have this deferred until the 31st of January 2021. Again, not written off or waived, just deferred. So if there are direct debits in place for these, then you're able to cancel these with your bank now. So basically there have been an improved package of reliefs and grants, and they've been set out in line with all of the UK announcements. 100% relief for all retail, hospitality, leisure and aviation businesses from 1st of April 2020. Businesses eligible for small business rates relief or rural rates relief will now be eligible for that 10,000 grant. Keep checking all of your local authority websites. And a 25k grant for those leisure, retail and hospitality businesses with a rateable value between 18 and 51k. So What I really would like to focus on now are the practical actions that directors themselves can take, and not actually just simply relying on what the government schemes are. So the economic impact of the virus will be felt across the business landscape, while some sectors will be more acutely affected than others, and the nature of our interconnected economy means that all businesses will be affected in some way to a greater or lesser degree. So the impact is significant. While the UK and Scottish governments have done what they're likely to continue to announce various support measures, the resilience of your business and your people will tested now like never before. So it really would be unwise to rely solely on government intervention, and all businesses need to consider what actions need to be taken to mitigate that impact. So what are the practical steps that directors and business owners require to take? Well, you need to look critically at their operations and consider how they could be impacted by the crisis. And all different businesses have different facets to consider, and I'm going to cover some guidance in that respect now. So if we look at sales, most businesses will see a change in demand. For some, a reduction, tourism, leisure industries, for example, but some will see sales spike. Look at the supermarkets, food and takeaway businesses, video technology, hand sanitizer businesses, and business and consumer behaviours adapt. Increasing or decreasing demand will present different challenges, and key considerations really should include proactive discussions with your key customers. Identify how that slowdown is actually affecting their business and their short-term to medium-term demand for the products and services. This will provide an idea of what resource you require to meet this and how it actually affects your cash inflow. Assessing different scenarios to consider the impact on profitability and cash flow. Remember, increasing sales could have an adverse cash flow impact due to your increased working capital. Again, banks are going to be looking at that when you're potentially looking for further lending and support. And even if demand continues, consider potentials around that continuity of supply. New customer businesses may look to you as an alternative supplier to reduce their own business continuity risks. You must undertake robust credit checks and consider requesting advance deposits. Have they actually experienced difficulties themselves? Are they actually unable to pay their suppliers? Is that why they are moving to you? You need to be forward thinking. You need to adapt your model. Your existing model may be significantly affected, but consider how you could adapt this to mitigate against falling demand. For example, restaurants are offering delivery services, and some enterprising taxi drivers are stepping in to offer their support there. Breweries may well see reduced sales because pubs are closed, but are they looking at doing again the kind of online delivery model? Cash flow. Well, in the wake of the financial crisis in 2008, the popular mantra was cash is king. Well, cash is king once more, and really preserving cash flow is going to be the critical objective of businesses in the coming weeks and months. Changing levels of sales will impact this, but even when a business can operate profitably, cash collection could be challenging as customers and suppliers tighten their own credit procedures. Businesses should look critically at this and run robust scenarios, identifying any shortfalls and implementing actions to bridge this. Do this on an ongoing basis. Cash flow forecasting should be done on a daily and bi-weekly basis. Utilize the digital accounting software that is there, the forecasting tools which integrate with your accounting system to enable a live view of cash flow forecasting, and you can amend it to reflect different scenarios. We have a cash flow tool suitable for businesses of all sizes, and it has the flexibility to modify cash inflows and outflows on a day-to-day basis as the circumstances evolve. It allows you to see the impact of government support initiatives such as furloughing staff, salaried or on an hourly basis, drawing down on business interruption loan schemes, obtaining grants and taking payment holidays for various taxes. These forecasts can be particularly useful if you're considering applying for additional bank funding. And I have a link that I can email to everybody following the webinar if anybody's interested in seeing that tool. So, having assessed your cash flow requirements, what are some of the options for alleviating any shortfalls? Well, maximise cash inflow, manage your aged debtors to identify what you can expect. Your customers may face the same challenges as you do, and try and find a compromise. Basically instigate payment plans, anything you can do to actually get that cash in, review credit terms, and wherever possible, reduce or remove these to speed up cash collection. Minimise cash flow in terms of calculate your burn rate, list your regular, your recurring cash outflow items, how much, to who, what are they for, and when do they fall due. Shareholders, directors, business owners, if you're considering raising funding from these, then think carefully about the structure of that. Chris has obviously touched on there already about making sure if you are investing funds in as a loan, actually look at the security measures there. Is it equity or is it debt? Could it be convertible to debt? If it is debt, consider the funds are invested, whether that security is in place. Again, Chris has touched on the Coronavirus Business Interruption Loan Scheme, and essentially there are challenges and hurdles in terms of actually putting that in place. Will we see something else coming from the government? Will the government look at actually injecting that cash directly to businesses? I guess we're hearing on the ground the same comments that Chris has talked about, in that it is challenging. Banks don't seem to have an appetite to lend to new customers. They're basically dealing with their own customers and actually looking at robust financial statements to actually evidence the requirements. So our view is that for many businesses who are most acutely affected, it will be challenging in the short term to be able to present a sound borrowing proposal. And this is more likely to be a solution for businesses as we emerge from the crisis to provide expansion funding and as the business recovers to previous levels. Again, the scheme's administered by the high street banks, and much will depend on their practical application of the guidance given to them by the British Business Bank. There's an HMRC helpline available, and a business can ask to defer tax payments, and each case will be considered on its own merits. Again, have the foresight to think you could be challenged on any funding sources. So you need to basically document and illustrate this through your cash flows and detailed planning and note taking. People. First and foremost, you need to look after yourself and your people. Your staff will be understandably concerned at this time, and clear communications are critical. You must be transparent. Adhering to the guidance from the health authorities is vital, in implementing social distancing if people are not working remotely. If one person has to self-isolate, you could really find yourself with a significant problem. And for many businesses, your people will be your biggest asset, but they also will be your biggest cost. Payroll, I can't stress enough the importance of actually getting your payroll done accurately at this time. You heard Debbie mention the challenges earlier about maternity pay. There's going to be issues around salary sacrifice, that people will want to amend what their actual net pay is so that they can potentially increase that to cover all their own personal outgoings. So we operate an outsourced service for thousands of businesses, and our team are up to speed with the new guidance on all of the statutory sick pay and the requirements that are there. So payroll is really, really key. Business continuity. Many of you will already have implemented your business continuity protocols, in particular around the remote working. You need to keep this under review. What you've had at the outset won't stand through the whole period, so you need to just keep adapting this as the guidance and legislation and as circumstances evolve. Identify your critical operations and your workforce plan if absence is a risk. Constantly updating your IT, your payroll, cash collection, payments, product service and continuity. Identify and communicate your chain of command with deputies in place for key roles, because nobody is immune to this. Review your IT infrastructure to support increased remote working. Assess the impact of your main physical space becoming unavailable, and review of key contracts is again critical at this time. Supply chain, it may well become disrupted as a result of coronavirus. You need to seek to have a full understanding as to the possible impact to allow you to consider any risks around continuity of supply, changes in credit terms and impact on pricing due to supply and demand fluctuations. Your business may well be one that is actually benefiting through the crisis in terms of sales, but it will only benefit if the suppliers can get their products to you. So if we take, for example, hand sanitizers, you can produce the liquid, but if you don't have any bottles to put it in, then that's an enormous challenge. It will affect you on a practical basis, and it will also affect you on a cash flow basis. It will affect your people, and it will have a roll-on effect throughout the business. So you may need to consider increased lead times for supply, which will again impact on that cash flow. And it may be you need to source alternative suppliers, and they may demand upfront payments because they again may have the uncertainty as to, well, why are you using them and what credibility do you have if you haven't worked with them before. So you really need to understand your supply chain and have that at the forefront of your mind throughout this. So what other measures are there? Chris has already touched in detail on the kind of provisions around directors' fiduciary duties. And again, wearing my licensed insolvency practitioner hat, I really would like to reiterate the importance of directors' fiduciary duties. It's an incredibly challenging time to be a director of a company, because not only are you leading and supporting your team through a period of uncertainty, which is affecting all facets of daily life, but a large amount of responsibility rests on your shoulders from a governance and compliance point of view. So I am not going to go into too much detail really on the wrongful trading provisions, because Chris has covered that off really well. And I've detailed there some of the other provisions that essentially can come up through the wrongful trading, through misfeasance and fraudulent trading, which haven't been relaxed through the potential changes in the new insolvency regime. But again, it just comes back down to the importance of cash flow and forecasting. It's very important to make a reasonable attempt to forecast your business financial needs during the crisis, and whether and when the crisis is over, enough cash will be generated to settle any loans or deferred liabilities incurred during the COVID-19 period. And it will be difficult, but there's a personal risk to directors if they're considered to have allowed the company to trade on without there being any reasonable prospect of the business surviving. And it's far better to have a forecast than prove to be wrong than no forecast at all. So finally, again, as Chris touched upon, the changes that implemented framework, it's unlikely these will come in until, you know, at least a month. But the aim of the change is to help directors to be able to act in accordance with their duties and to help companies steer through difficulties and avoid insolvency during the pandemic. There's also been, as again Chris touched upon, the Scotland bill that was passed yesterday, as there's been a relaxation in the moratorium rules for individuals, that they can apply for a moratorium now for a 6-month period to assist them if they are having any personal financial difficulties, so they're able to seek help throughout this period. So again, like the Chamber and Thorntons, we have a COVID section on our website, and all of the latest information that we have is updated on there on a very, very regular basis. So thank you for listening to me, and I will just stop now to allow time for questions and answers. Thank you.
Jen, thanks very much for that, and thanks very much to Debbie and Chris as well. We've got some questions going on in the chat here. I'll probably just bring them in. If you want to come off mute, it's probably your best bet. And we'll just start with the most recent one there from James. James, are you there?
Yeah, I'm here. So yeah, I guess can everyone hear me? Yeah.
Yes.
Loud and clear.
Okay. Fantastic. So yeah, I guess the question was really about the furlough scheme. So I think it seemed like a few businesses were a bit confused about the way that works in terms of cash flow. So is it correct to assume that you essentially you tell your workers they're on furlough, so that from that point onwards they're not working, you continue paying them, and then you apply, so the application process isn't available online, so it's after that then you apply to HMRC, and then it's a retrospective claim back of those wages that you've already paid out as an organisation. Is that the correct process? Or?
Yes, pretty much. I think the thinking is exactly as you say, that you will continue to pay the employees at that level or topped up, and you will be reimbursed. It's to encourage obviously the maintenance of people's income. There have been some employers who have been quite widely criticised for adopting an approach that is, we'll pay you when we get the money from the scheme. I think they are hoping that employers keep the faith a little bit. Now I understand that's easy to say, and I think the suggestion is that you could perhaps use, you know, a business interruption loan or another facility to cover those until the money comes through. The scheme isn't open yet, so the portal, they're saying the portal should be up at some point in the next couple of weeks. They have said they're hoping to get payments out relatively quick. You know, at one point they were talking about by the end of April. I think you have to be realistic and assume that it might take, you know, it's likely to take a bit longer than that. But they will have to, I mean, what we're saying, they will have to do this quickly, or employers will lose the faith and they will have to make very tough decisions. And the whole point of the scheme is to try and avoid those redundancies. So they will have to move quickly.
Okay. Brilliant. Yeah, that makes sense. Thank you.
No problem.
Thanks, guys. Jen, I think you were saving a question for Debbie, I believe, if I remember rightly from the start of our call.
It was. I had asked Debbie, basically, if employees have been furloughed, are they able to work for any other employer? And then another one on the back of that is that if employees are furloughed, are they able to join in any Teams calls, you know, on a daily chat, coffee and catch up, so as to look at protecting actually their mental well-being while they're furloughed at home in isolation?
Yeah, so I mean, but yeah, thanks, Jen. I mean, just taking the latter one in terms of the team calls, as I said, they're not to provide any work for you that provides a service or generates any income. They are, however, allowed to carry out some training. I think that keeping in touch with them is quite important, and as you say, for their well-being, and so they still feel like, you know, as they are still an employee of the business. I think you would just have to be very careful that that doesn't then, you know, spill into them doing work. So it's just to keep an eye on that. In terms of other employment, that's an interesting question. I've been asked that a couple of times. I think that if employees, it's an easier one if people are shift workers or part-time workers and the work that they undertake for another employer is out with the hours that they would normally be carrying out for you. I think there is a potential issue if they work for paid work, if they're carrying out paid work during hours that they have been furloughed for. It's hard to say because we don't know how closely HMRC are going to look at this, but they have reserved the right to audit employers. I think it's only an issue for an employer if they've been complicit or expressly agreed that they can go off and work elsewhere, and then the employers then made the claim. HMRC could view that as an abuse of the system. So it's just be careful what the communication that you're having with your employees about that. The idea is to replace their income, not to, you know, it shouldn't be essentially a windfall for them. So I would be careful of that. I see there's another question, sorry, for me from Stuart. I don't know if you want me just to deal with that as well on the eligibility of job retention. Yeah, eligibility of job retention scheme for company directors who work in the company as their main job. That's a good point. And again, my view would be if you are on the payroll and you are and there's PAYE for you, and that was in the sense of your salary that you have paid PAYE on, I think you will qualify for the scheme. It's an HMRC system, so from that perspective, I think you will. Obviously, it's a different position in terms of the dividends, but I think as a salaried, in respect of you being a salaried employee, I think you can make a claim under the scheme.
Thanks.
there's any other.
That seems to be. Oh, I think we're point taken off again.
Am I? There's another one. Oh, okay. Here we go. Right.
From Lauren, yeah.
Yeah, okay. For Debbie. On payroll on the 28th of February, so I'm just moving this down. Payroll on the 28th of February and a contract dated the 24th of February, started work the 2nd of March. Can they be furloughed? Again, I think it comes down to your presence on the payroll. I've had a couple of, I have to say, I have to caveat this, as lawyers always do, that we can't be definitive, but it seems to be about being on the payroll. So I've had questions from clients who've said, right, we've got somebody on the payroll, but they were on, you know, for example, they were on a secondment and that for that period of the month. I think if they're on the payroll and they were due back and so due to be working, you would make the claim from the second, you know, you can furlough them from the 2nd of March. Because they were on the payroll on the 28th of February. I think, given the circumstances is that they hadn't started working to the 2nd of March, though I think that is slightly, I'm not sure why they were on the payroll on the 28th of February if they hadn't started work. But I think it could be scrutinised further, because the idea is that that's the cut-off. But I think that's a slightly unusual situation. So I'm not sure that entirely answers your question, but I think it will be who's on the payroll, is my understanding.
Thanks for that, Debbie. It's Lauren here just now. I was typing really quickly because I thought we were going to get cut off, but that kind of answers it. It's such a grey area, isn't it? So
it is. I mean, I think there is an element of risk with something like that. If they hadn't started work, they could come back and say, "Oh, we're a bit unhappy about it." But I think I have to say, and I'm probably the volume of claims that HMRC are going to be making, they are dealing with it as an HMRC issue, not an employment law issue. They are going to base their assessments on payroll. If you were unlucky enough to be audited afterwards, you might have to ask some questions around it. But the guidance says it's payroll.
Oh, that's clear, Debbie, for me. Thank you.
Thanks, Debbie. We've got another question there from Stuart about repayment holidays for EFG loans.
See, Ian actually has helpfully answered that, seeing as we have a helpful banker actually on the call.
Stuart, does that help you out? Ian,
it does. Ian is actually probably the best source of help I had last week when I was trying to get through to the bank for a day and a half on hold, and he called me through the chamber, which has, as I say, been the most helpful thing. Their message, the bank, has been really inconsistent about this. When I finally did get through, I spoke to a business manager who said that we will be looking at a 6 months repayment holiday for our EFG loan. He then said that I would receive information via email, which I didn't. So I phoned back the next day. Thankfully, it was only half a day on hold this time, and spoke to a different business manager, and she said that that wasn't confirmed to be happening. So I think, obviously, a bit of distress about the inconsistent message, but I think they are looking at doing it whilst I've been on this webinar. Excuse me for going away, because the Bank of Scotland actually phoned me about my CBIL. So when she told me about that, I asked about the repayment holiday, and she says she's going to get back to me on it. So she seemed to be quite positive about there being some sort of repayment holiday, just as Ian described to me on the phone at the very start of last week. So thanks again to Ian for that call. It was much appreciated.
Brilliant. Thanks, Stuart. James, another question in there as well about raising finances as debt or equity. Quite an interesting question.
Sorry, I'm hogging the questions here, but no, it's a question for if possible. So I guess so this is kind of slightly different to the conversation of support, but what's your opinion on how it looks like in terms of raising finance for businesses? Has there been businesses out there, they're still raising finance, looking to grow? Is there an appetite to still invest in businesses, and also how does that look like from a kind of either a debt, so there could be opportunities here for businesses to do some debt financing if they want to grow, and then also from an equity perspective as well, in terms of high net worths and some of the syndicates out there as well is interesting. I mean, I guess from a short-term perspective, and also maybe even long-term as well. What do you have any idea what it would look like after the crisis as well?
Do I have a crystal ball? Do you mean, James?
Sorry.
So basically, we are seeing activity. It's sector specific. Clearly, obviously, some sectors are doing extremely well at the moment, and there is still an appetite for essentially looking at raising finance and investment there. There are people that see there are opportunities when essentially values are dropping, so it's a time for actually people with cash and wealth to be able to actually invest. So we are seeing activity in that regard. So really, it's sector specific. There has been a drop. Some have sectors and some interests have fallen off the cliff, but we are seeing activity and positive movement in some sectors.
Okay.
If I could just pick up on that as well. I think the issue is that this is not necessarily a good time for equity investment, because what's going to happen across the economy when the job retention scheme is removed is that at some point following that there's going to be quite a few insolvencies, and the first thing that's going to get wiped out is the equity, and there'll probably be quite a lot of insolvency restructuring there where directors are buying businesses back out of insolvency, or they're going to the wall. If you had to put money someplace, I would suggest it is debt rather than equity.
Yep, I agree.
Fantastic. Yeah, great. Thank you.
Great stuff. Do we have any more questions from anyone? We're just a bit conscious of time here as well. It's fine, okay, no problem. I think at this point then, I'd just like to thank our speakers again. Thank everyone for joining us. Pass you back over to Sarah, who will close the webinar.
Thanks, Ross. Yeah, just want to kind of reiterate what Ross just said there. Thanks very much to our experts. There's been a good bit of chat and conversation, and certainly lots and lots of information to take in from the experts. If anybody does think of any questions afterwards, then just feel free to email me, and I'll connect you with the team who we're speaking today. Ahead of next week, we'll be putting our webinars for next week live in the next 24 hours, just finalising a few more speakers for them. Regular Tuesday networking session for members, our coffee and cake at 2:30. We've then got Wednesday, we're looking to host a webinar around leading a virtual team. So looking at what other organisations are doing to motivate their staff, how they've adapted quickly in technology, etc. And then Thursday, hosting a webinar with the team at Marsh Commercial, also IT Works, and we'll have a risk management specialist speaking about risk management within organisations, and also looking at business resilience and business continuity as well. So we'll have those listed in the next 24 hours. Get yourselves booked on. And yeah, thanks everybody for coming along. We'll have the webinar up in YouTube as well. We've got a YouTube channel where all our webinars are. So if you miss out on any of them, don't worry, just head onto the channel and you can rewatch them. Okay, we'll see you all soon. Thanks, team. Bye.